Okay, we're back continuing the accounting cycle. Today we're going to go through step 6, which is to prepare the 3 primary financial statements. The 3 primary financial statements include the income statement, the statement of owner's equity, and the balance sheet. And the thing that's important to kind of suggest here is you need to make sure that you prepare them in this order. The reason that is because I need information from the income statement to help me prepare the statement of owner's equity. And then I need information from the statement of owner's equity to prepare the balance sheet. So make sure you know they need to be prepared in this particular order. So let's break each of them down. So the first one we look at is the income statement. And only 2 categories of accounts go on the income statement, and they are revenues and expenses. So what we do is we take our revenues, we subtract out all of our expenses, and we have 3 potential outcomes. We could have net income, and in that case revenues are greater than expenses. We could have net loss, which means that revenues are less than expenses. Or in the very unlikely scenario, we could have break even where revenues exactly equaled expenses. This is not common. I have really never seen a situation in any type of textbook that has suggested a break even in an actual prepared income statement. We may later on in accounting 2 see how much we have to have in revenue to break even, but that's not suggesting that it's actually going to come out as a break even scenario. So a couple things here. Now remember, the income statement will be for a time period, things like for the month ended, for the year ended, for the quarter ended. So we'll have that for a time period. And then one of the most common mistakes that we see on the income statement is unearned revenue showing up there. Well, it will not show up on the income statement because it is a liability. We owe services because they were paid for in advance. So make sure you do not fall into the trap of putting unearned revenue on the income statement. The other thing that I see that's very kind of curious to me is why people would do this. There's no cash on here. There's no land, there's no building, there's no accounts receivable, there's no accounts payable, nothing of that nature whatsoever. There's no assets or liabilities of any sort on the income statement. So never put any assets or liabilities on there, and we do not impact or have owner's withdrawals or owner's capital on here either. So just revenues and expenses on the income statement, and that is it. So I need to have the net income or net loss calculation to help me then prepare the statement of owner's equity. And the key thing here is you want to remember BASE, B-A-S-E. So what does this stand for? Well, we're going to see that we're going to take our B is going to stand for the beginning balance of the owner's capital account. Then we'll have 2 sections, one where we add stuff, there's the A, one where we subtract stuff, there's the S. And then that will yield our ending balance of D current capital. The E is there. So B-A-S-E, so beginning, add, subtract, ending. So if you remember that, hopefully this will kind of jog your memory here. Now, what do we add and what do we subtract? So we have to think about this. If we go back to wire, withdrawals, investments, revenues, and expenses, we remember that those are the 4 things that impact owner's equity. So we have to go through each of those things and determine where they fit into the picture. So if we look at withdrawals first, we could see that obviously that would cause owner's equity to decrease, so we would subtract that. If we look at investments, we know that if an owner makes an investment in the business, the owner's equity is going to increase, so we would add that. Then we take the revenue and expense piece. Well, remember in the statement of owners, in the income statement we previously prepared, we calculated revenues minus expenses and got either net income or net loss. So obviously if we have net income, it will fall into the add area. We will add net income. Or if we had net loss, we would subtract it. So remember, you only have one of those as a possibility. You will not have both. So you will either add net income or subtract net loss. So once you do all of this, you will yield your ending balance of the owner's capital account. Just a note here, sometimes you may have investments by the owner, sometimes you may not, sometimes you may have withdrawals by the owner, sometimes you may not. So just kind of keep that in mind. You don't have to have all of these each time. And if in the likely event that you had a break even on your income statement, you would do nothing here because the answer would be 0 on the income statement, and there would be nothing to add or nothing to subtract. Okay, then we get to our balance sheet. And our balance sheet basically is the financial position of the company, and we basically look at the accounting equation. So here's our accounting equation, and we have our assets equals liabilities plus owner's equity. A couple notes here. Remember, this will be different than your income statement or statement of owner's equity. This will be for a specific date in time. So if you had for the month ended December 31st of 2016, for your income statement and your statement of owner's equity, this would be just dated December 31st of 2016. The reason is because as soon as we get done this, the balances of these accounts will change. So let's look at this a little bit closer. Now, the main thing that we have to do is we have to take all of our assets, and the thing that we got to be careful of here is we have to make sure that we calculate the book value of our depreciable assets. And remember, we do that by taking cost minus accumulated depreciation. That equals our book value. We will need to use the book value number to help us get our total asset figure. And we will see how this works when we do the comprehensive problem illustration for this balance sheet. So you'll definitely see how that works there. Then we take all of our liabilities, and then we have to add it to our owner's equity. Now remember, in the previous financial statement, the statement of owner's equity, we calculated the ending balance of the owner's capital account, and we would use that here in the balance sheet for the capital balance. So one of the most common mistakes I see is students failing to bring the ending balance of the owner's capital from the statement of owner's equity into the owner's equity section of the balance sheet. Okay, so this concludes this step 6 video of the background. Let's go ahead and take a look at this as a problem illustration.